Choosing a financial advisor isn't an easy decision. After all, it's your money at risk, not theirs, so it's vital that you do some digging beforehand to make sure that you're not potentially handing your life savings over to someone sat on ChatGPT asking what they should do. While it might seem quite daunting to think about, and you can potentially go the DIY route and manage everything yourself, hiring a financial advisor can have a lot of benefits. They can help you with things like tax strategy, estate planning, preparing for retirement, and more. But in order to choose the advisor that suits your specific situation, you'll need to be prepared with a whole host of questions ready to grill them. And that's why this video exists. We'll be giving you all the most important questions that you should be asking a financial advisor when talking to them, way before you even hire them, and what to look out for in their answers. While some of these questions might seem a little over the top, any qualified financial advisor should actually welcome them, as it shows that you're serious about your financial future. The first thing we need to do though is clarify the difference between guidance and advice. With financial guidance, your money will never be managed for you. Instead, you're being given the information and tools to make your own informed decisions. Think of it like financial coaching. They're not there to do it for you, but to help you understand your options so you can choose what's best for you. They will never recommend a specific product or investment. Financial advice, on the other hand, is a regulated service where a qualified advisor gives you specific recommendations and may even manage your investments on your behalf. Quick example, financial guidance might outline 3 investment options, A, B, and C, giving you their pros and cons, while financial advice could recommend option B because it best suits your goals and risk level. You can get both guidance and advice from a qualified financial advisor. But I'll start with guidance-focused questions. This is what you'd seek out if you don't have hundreds of thousands of pounds to invest at a minimum. Then we'll move on to questions more specific to regulated advice. Obviously there will be some overlap, and some questions will apply to both. So, guidance. Let's say you've just landed a new job that pays you significantly better than what you were earning before, or you've just inherited a chunk of money, say 10 to 50,000. You might want some guidance on how to handle the new pot of money at your disposal. And scenarios like this are where you might opt for a one-off bit of guidance with a financial advisor, rather than an ongoing wealth management service. The first, and arguably most important question that you need to ask when receiving any sort of guidance or advice isn't anything too crazy, but it is vitally important for you to clarify. What qualifications do you have? Your financial advisor should be expecting this question, as they'll have received it many times before. So if they start to seem flustered or tell you that their highest qualification is a B in GCSE maths, then run. With that being said, it's important to clarify that you don't need to be qualified to give guidance in the UK, as it's not actually regulated. But you absolutely do if you're providing financial advice, so bear that in mind. By law, financial advisors must have at least a level 4 qualification, for example a diploma in financial planning, and they have to maintain a statement of professional standing, or SPS, which is renewed every year with up-to-date training. So, if you're planning on trusting a person with your money, or even just receiving guidance, it's a major red flag if they don't have these credentials. Another thing to clear up before you begin is whether they'll need any access to your financial accounts. And seeing as they are only offering guidance in this scenario, this should be a quick and easy no on their end. If they try to convince you that they do, then this is also a big red flag. However, they will need to gather information about your financial position though, and may ask for financial statements. So if they do ask you to sign a letter of authority, or LOA, just clarify with them that this is only to give them information about your accounts, not access to them. If you're concerned about making your own financial decisions in the future, even after receiving your guidance, you can always ask how they instill confidence into their clients to make these decisions for the long term, without the help of a qualified advisor. If your only meeting is a one-off and don't plan to chat with them regularly, it is crucial that you understand what they are teaching you and that you're able to ask any questions you think of, regardless of whether they might seem silly. So there are some key questions to ask before receiving financial guidance specifically. But from this point on, the main focus will be financial advice. Like I said, a lot of these questions will be relevant to both, to save me repeating myself. After you've asked for their relevant qualifications, you need to make sure that they're fully regulated. If you're trusting this person to invest or manage your money, you'll want to know that they are either part of an official financial advice firm or regulated as an individual advisor. To do this, you could ask, are you regulated by the Financial Conduct Authority, and can I find you on the FCA register? As long as you have the advisor's name and the FCA reference number, you should be able to look them up on the register, so I'll leave a link to that in the description below. For those of you that don't know, if a firm is regulated by the Financial Conduct Authority, then they have to abide by a long list of rules and regulations when it comes to dealing with your money. So they can't just take your savings and dip. You can also use the FCA's website to check for any negative reviews of this advisor, which is a really handy tool to help you in your vetting process. If your advisor doesn't appear on the register at all, then that's the biggest red flag you could possibly ask for, so get out of there ASAP. No FCA regulation means no FSCS protection or financial ombudsman service. Basically, if they lose all of your money or run off with it, you're not protected up to £85,000 and have no grounds to make a claim to get anything back. It could just be a complete scam. Another thing to make sure of before you hand your cash over is that the platforms that your advisor uses are also regulated by the FCA, and they're not just holding the money inside their own account. This will give you 2 layers of protection. If the platform they're using goes bust, you can claim up to £85,000 back from the Financial Services Compensation Scheme, and this amount is rising to £120,000 as of the 1st of December 2025. Or, if the advisor loses all of your money due to negligent decision making, you have the Ombudsman service to call on, and they can order the firm to pay you compensation directly. With those important opening questions out of the way, you should hopefully now feel confident that this isn't someone sat in their mum's basement trying to gain access to your savings pot, and that this person is fully qualified to handle your money. With your mind at ease about the safety of your cash, you can start to ask some deeper questions about what you're hiring them to do. A great way to get this information is by asking what services they offer and whether they are independent or restricted. By asking what services they offer, you're getting an idea of how much they can help you with. Whether that's purely investing your money with the aim of growing your balance over time, or a more in-depth service where they can advise on things like inheritance tax, retirement planning, selling a business in the most tax-efficient way, and so on. If you know exactly what you need from an advisor, then this information will be key. But even if you're going in as a blank canvas, this will give you an idea of what they can offer. The second part of the question, are you independent or restricted, refers to regulatory labels that are important to know. If they're independent, this means they're able to recommend investments from the entire market to find the best fit for your unique circumstance. Whereas if they're restricted, they might only be able to recommend specific investment products, like particular funds, or they could be limited to certain product types, like retirement products, and might even be tied to a bank or insurer and can only recommend products from their offerings. If they do come back and confirm that they are restricted, you can ask, does that mean you can only recommend products from certain providers? If so, which ones and why? Restricted advisors are limited to recommending certain products, usually those offered by their own firm or a select group of providers. This means your investment options may be narrower and could align more closely with the firm's offerings than with the entire market. With that in mind, restricted advice isn't necessarily worse, but it often can be because of these limitations. With an independent advisor, you'll have an unbiased selection of investments from all corners of the market. Depending on your own personal situation, the advice you receive will vary. If you're a multi-millionaire who's handing over 7 figures, there is no doubt that it will be dealt with differently to giving them £20,000. In fact, most, if not all, financial advisors won't take you on if you've only got £20,000. Not that £20,000 is a small amount of money, but because the cut they take simply isn't big enough to make it worth their while, and therefore they can't give you the time and attention that you need. So if they are willing to take you on at this level, then that in itself would be a red flag. For that reason, it's great to ask them who their typical client is, and have they worked with someone who's in a similar position to yourself before. This is a question you should be asking whether you're receiving guidance or advice, as it's good for you to know that they have experience when dealing with situations similar to your own. Some advisors are selective and have a cut-off point of how much money they're dealing with, whether that's £250,000 or even £1 million minimum. It's also common for certain advisors to specialise in specific situations, like business owners, retirees, or expats to name a few. You should be taking this into account to help you find the right fit. If you have millions saved up, then you need a professional who's used to that sort of client. And the same can be said if you have a smaller balance. You don't want them to think of you as a budget client that they can just give to the intern. To dig even further, you can ask for a few examples of work they've done for similar clients. And this isn't you asking for specific names or account details, just certain things they've done in the past, like tax planning, inheritance, things like that. If you're coming into it with a large balance, then a good advisor that's used to dealing with these sorts of clients should be confident with things like inheritance tax planning and trusts. Whereas if they start to waffle on about a load of nothing and seem a bit hesitant, chances are they're a bit out of their depth. Let's say it's all looking good so far. They've answered confidently and you're ready to proceed with the service. Before you go ahead and hire them, you should be asking what they charge and how much you can expect to pay for your situation. All advisors must be upfront about this fee and will offer an initial meeting at no extra cost to you. There are a few ways you can be charged, and the FCA actually requires advisors to disclose their fee structure before taking on a new client. If they charge by the hour, then this can often cost between £75 to £500, with a lot of advisors costing around £150. If you're happy paying by the hour, then make sure to ask roughly how long the job will take, so they can't sit back and tally up the cost like a black cab in London would for a tourist. If you're looking for a fixed fee, then this will depend on the specific task that you need help with, like upwards of £1,500 for a financial plan or £5,000 for a more complex strategy. You could instead pay a percentage of your portfolio every year, usually between 0.5 to 1% on a £1 million balance, which would equate to £10,000 a year. But this method could also come with a setup percentage as well. Then you have monthly retainers, which will be a flat monthly fee, and sometimes you may pay asset-based fees alongside this. There are also a couple of considerations when it comes to fees. Firstly, you don't want to overpay, so you can ask them to show you how their fees stack up against the value they'll add to your portfolio. Secondly, if they say something along the lines of, "The advice is free as I get paid by the investment company," this is a major red flag. Commission on investment products was banned in 2013, and the only exceptions to this are certain insurance or mortgage products. But if that's the case, then they should explain this to you before you even get to that point. Seeing as you're paying big bucks for someone else to invest your money for you, you need to know what their approach to investing looks like and how they actually do it. A good starting point is asking whether they take an active or passive approach to investing. Active might sound positive, but all this means is that they'll be manually picking and choosing stocks that they think will perform well and trying to beat the market. Something that very few active managers are able to find success with, as most of them cannot beat the market consistently, especially when you include the fees that you'll pay. Passive management, on the other hand, sounds like they'll be sat back without a care in the world while your portfolio dwindles, but in reality, a passive approach means they'll be putting your money into low-cost index funds that track the market, and this makes it easier to have a diversified portfolio that can meet your investing goals. After asking this, you can follow up with another question. How do you decide the right investment mix for a client? A positive answer to this will be one where they start with your risk profile, goals, and time frame, then build an investment portfolio from there. If you have any ethical preferences when it comes to investing, then this should be the point where they ask you what they are and take them into consideration as well, although this will often come at a higher cost. However, if they ignore all of that and go straight for their own selected fund, it might be time to reconsider. These two questions will both give you an idea of the strategy that they deploy, but that's not all you're interested in. It's a good idea to ask them who will be making the day-to-day decisions when it comes to investing, as it might not always be the person that you're talking to. This might not matter to you personally, but it's always good to know exactly who is handling your money. Finally, you can ask them how their reporting works. Will you get clear and regular performance updates with realistic benchmarks? These are all things that are important to know. Even if your financial manager is focused on retirement and takes a passive approach to investing your money, they still need to maintain your portfolio as time goes on. So make sure to ask whether they offer ongoing advice or portfolio management, what that will include, and how much will it cost. Communication is also important. Are they free to call or email often, or do you have to send your question via carrier pigeon? If you've already struggled to get in contact with them up to this point, that's probably a sign of what's to come. Then you can ask what the process is when it comes to ending the service. How long is the notice period? Make sure you're clear on what you're signing up for, as you could be committing to a certain amount of time with the advisor, and this is known as a lockup period. Or there might be a hefty fee if you want to cancel the service. One of the main reasons people call on financial advisors is for help with their taxes, mainly to figure out how to avoid paying unnecessary amounts. They should be on the ball with things like dividend tax, income tax bans, and inheritance tax, with strategies in place to soften the blow on all of these. And these can include residence nil rate bans, trusts, life insurance written into trust, or other estate planning tactics. A sensible way to approach this topic is by asking if they're able to refer you to tax advisors or lawyers when needed. If the answer is yes, then you can rest a little easier at night knowing that it's not only your advisor looking after your funds, but a selection of legal agents ready to defend your capital like the A-Team.
You probably think that's a picture of my family. It's the 8.
You need to keep in mind as well that you're not only planning your investments, but also for major life events along the way. Things like retirement targets, any school or university fees for your children, mortgages, and even money you're planning to pass down should be taken into consideration by your advisor. So be sure to ask them whether they'll look at the whole financial picture or just your investments. And one more thing to clarify with them is whether they'll be gathering information about you and what they'll need. By regulation, they have to do this, and it should include things like your finances, needs, and approach to risk. It's considered a red flag if your advisor immediately jumps into an investment recommendation without learning about you first, as that is considered a violation of standards. An additional consideration you could have is the relationship that you have with the advisor. Do they feel like someone you could reach out to with a question as and when? Do you genuinely get on with them? And most importantly, perhaps, how will they help manage your own mindset when it comes to money? It's inevitable that over the time you're using an advisor, they'll likely have to break some sort of bad financial news to you. So it's always good to know that the person you're working with is able to not only give you that news, but also guide you through it as well. For example, if your strategy is long-term growth and the markets suddenly crash, how will they respond in a way that best manages your own mindset towards investing? Also, are they speaking your language and making you feel comfortable enough to ask any questions you might have? Or does it feel like they're trying to sell their own products to you, dressed up in a facade of financial advice? Chatting with your advisor shouldn't feel like trying to decode the matrix. They should be able to communicate in a way that's easy for you to understand. After all, your finances are potentially in their hands. So at the very least, you want to be able to discuss any concerns that could crop up and not feel confused by their financial jargon or like you're being pushed into any decisions that you're not comfortable with. It might not be the first thing that springs to mind when you're thinking about what you want from a financial advisor, but having a good relationship with streamlined communication won't just help you get the service that you're paying for, it will also put your mind at ease throughout the whole process. That's a lot to digest, so if you want access to our free cheat sheet that details all of the questions you can ask, you can click the link in the description. And if you need any help finding an advisor for guidance or advice, you can book a free call with our sister company Most via the link below. Asking all of these questions before you choose a financial advisor is necessary to make sure that your money is not only safe, but in heavily regulated hands. If you're still questioning things and want to do a bit more digging into your potential financial advisor, you can always look up reviews of their service on a site like Vouched For. While to me and you they might seem like overly detailed, picky questions, a good financial advisor should eat them for breakfast. They've trained their whole lives in this field, so should expect a good grilling. The first couple of meetings will likely be spent laying the foundations, figuring out your risk tolerance and what your goals are. Then, after they've got to know you as a client, they'll start explaining how they plan to help you achieve those goals. If they seem hesitant while answering or insist that this information doesn't matter, take that as a warning sign and proceed with caution. Remember, your financial future rests on their shoulders.